How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And
all right, welcome back. Invest Info episode 9. A short focus is not conducive to long profits. A quote coined by Warren Buffett. He was asked why he doesn't, get stimulated or go or doesn't invest it on Wall Street. He stays in Omaha, Nebraska, and that's because he doesn't want to get overstimulated, right? And he said a short focus is not conducive to long profits, and we're gonna speak a little bit on that. I also want to go to another video. Now, this is Mark Meldrum. He manages over $20 million. And we're going to speak about going short versus long and how does that affect our investment strategy. So I'm going to go ahead and play a snippet of this video.
Again, the comment section, I think under a lot of videos, there's a lot of vitriol and a lot of hatred out there. And I think that the owners of these channels have a responsibility to say, look, if you're going to have anger, bring it somewhere else, but you're not bringing it to my side, okay? Okay, let's talk about levels. You have to really think about this market in terms of the players in this market. If you want to understand how the market works, you have to understand who's playing the game. And the big dollars are institutional money. And you're talking about foundations, endowments, pension funds, and mutual funds have a long-only bias. You're talking about a lot of funds out there that have a long-only bias. ETFs, again, that track a particular index. They buy indiscriminately in a certain basket. And all of these institutions have an investment policy statement, an IPS. And in that IPS, they have what's called a policy portfolio, which says what the allocations are to every asset class. So let's take a really simple example, a 60-40 allocation, 60% to equities, 40% to bonds. And let's say that that is an institution's policy allocation. Well, with this last sell-off that we had, what's going to happen to the allocation for that fund? They're going to find that there may be 45% equities and 55% bonds, because with that drop in rates, the value of bonds have increased and their equity holdings have decreased. And many of these institutional funds are limited to holding investment grade bonds only. So they didn't hold a lot of those high yield corporate bonds that really suffered. Their bond allocations increased in value. They're going to rebalance. Rates are going to be low for an extended period of time, so they're going to get very little yield out of those bonds, and they're going to have an allocation to an asset class that is overvalued or maybe rightly valued based on where yields are, but overvalued based on reality, because that's a very engineered yield curve we have right now. Well, they're going to take that and they're going to reallocate it to equities. That's it. They're just going to reallocate to equities. They're going to buy because their horizon is 20 years from now. It's not tomorrow. They're not trading for tomorrow. They're not trading for next week or even next quarter. They're buying for 10, 20, 30, some even 50, 60 years. Endowments, foundations, perpetual investment horizon. They need allocation to growth assets, and now's a good time to buy it, because in 20 years, where's it going to be? Higher. Let me demonstrate that to you. Let's say that you bought equities in 2009, and I'm not going to pick a level. Let's not, be unfair and pick the bottom of the market. The bottom of the S&Ps was 666. Let's say that you saw it come up 50% from that level, and let's say you bought at 1,000. That's a 50% retracement from the bottom. You said, okay, well, I'll buy at 1,000. You put $1,000 into it, and you just went away, and you woke up today. Well, the index is at 2,800. That's a 180% return on your money, not counting dividends now. That's a 180% return in 10 years. You look at that and you say, that's pretty good. And then somebody tells you, yeah, but there was a massive sell-off. Well, what does it matter at that point in time? I'm up 180% in 10 years. 180%. There's a 7-10 rule in the market that if you get 7% a year, it takes 10 years to double your money. So you've more than doubled your money in 10 years. So that means your average return, even with all this, was over 7% a year. That's not counting the dividend reinvestment, which is another 2% compounded per year. Even if you measured it at the bottom of the sell-off, that was 2,300. That's still a 130% return over 10 years. So where are we going to be in 10 years? Higher. You're going to have a positive return over 10 years, and that's what these big institutional funds are looking at, because their allocation has a long-term investment horizon.
All right, that's pretty much the point. When in equities, you have in the stock market, you have people that are long the position, which means they plan to buy more in the future, and you have people who are short the position. If you're short the position, it means you're planning to sell in the future. Now, he deals with the real estate MREITs, real estate mortgage, real estate investments trust, right? Stocks that deal with real estate, right? And he picked a stock. Not going to name that stock, but the stock is recovered. We're in something different, but we have the same philosophy that there's more institutional buyers than there are sellers. They're going to keep buying this thing. Now, does that show in the stock price? Not immediately, but over time it will. And most retail traders, what they do is they trade or chase the current hot stock of the month or the week or even the year. But institutional buyers, the people that really move the market, they're forward thinking. So we want to find those stocks. We want to pick those companies that, even if they're necessarily in a downtrend, that these institutions are buying. And you could check this on Yahoo Finance. If you go to Yahoo Finance, you look at the particular company that you've picked, you can look at the institutional buyers, how many of the percentage of the float, how much percent of the shares are owned by institutions. You have different apps like StockWits and other different apps, Seeking Alpha, that will tell you, based on the stocks that you pick, how institutions are trading the stock. So if there's more people long a stock, if there's more people long a position, if there's more people planning to buy in a position, mainly institutions, we want to pick that company and profit from the way out. Now, you might say, man, I don't have 10 years to get rich. I don't have 10 years, 5 years and such to wait. Well, this is why we watch the previous videos where we say, look, does it pay a dividend? Does it pay a nice dividend? Because he mentioned dividend, and dividends do compound over a period of time. Great, it pays a dividend. Do I have enough money to make a significant amount off the dividends? If not, then go back to lesson 1. I could always borrow, right? I could borrow or leverage a loan, put it into this particular company, and over time, the company will pay me back more in dividends, and also a sell-covered call strategy, which I plan to do a lesson on as well, that will outbeat the rate of interest that I'm paying on the loan that I've borrowed. And I profit from not only the spread, well, mainly you're going to profit from the spread, but you're going to be collecting passive income as well. So, as Warren Buffett was saying, don't get caught in the hype. Don't get overstimulated. Invest in something you understand. If you have the ability to leverage. And look at what institutions are doing. As Monash said, there's nothing wrong with copying. So you look at what the top investors are doing. For instance, Warren Buffett, during this crisis, he purchased also a real estate stock. He purchased liquid natural gas companies. Things that the young people are not looking at. It's not hot right now. But these guys are forward thinking. So we want a forward thinking mindset when we go into purchasing these businesses, and we don't want to be overstimulated by the crowd. We want to be independent thinkers, and we want to understand what we own. All right, so that was another lesson, and I'll see you on the next one.